Is NAPCO Security a potential multi-bagger? Is it a good opportunity for this small cap? We'll analyze this company in this video and discover everything that you need to know before investing in this stock. So in this video, we are going to talk about the business, the numbers, of course, to see if it's a quality company, the quality of the business, of the moat, and so on. And of course, the value at which price it's interesting to buy some shares of NAPCO. Okay, the latest events are the price dropped 36% since August due to accounting fraud suspicion. Okay, there are suspicion, nothing is sure, but we had like some articles and some debate on Fuzzy Panda that was saying that they suspect them to have some accounting problems. There is, thanks to this or because of this, whatever, a lot of short sellers. A similar drop happened in 2023, okay? And the margin are getting higher and higher for this business. Can we have a similar scenario than FICO with the arriving of a new, not business model, but new product with higher margin, new software recurring revenue, and when it arrived to FICO, the stock totally rise. Can the similar thing happen with NAPCO system? It's what we'll discover in this video. If you compare the performance compared to S&P 500 over the last 5 years, NAPCO system returned 135% for shareholders and S&P 500 96%. So yes, this company is a small caps that is actually beating the market. NAPCO was founded in 1969, okay, by Richard Soloway. This represents the beginning of what would become a major security technology company through as private company initially, okay. In 1972, it's the IPO and providing opportunity for the public to invest in this company. In 2018, it's the launch of the cellular communicating Starlink LTE line, which marked a significant shift toward a recurring revenue business model through cellular communication services. This strategic move has been particularly valuable for shareholders as it created a more predictable revenue stream. In 2020, it's the introduction of the Air Access platform, marking NAPCO's entry in the cloud-based access control market. This expansion into cloud services represents another potential recurring revenue stream. And finally, in 2023, they reported a strong financial results showing record-breaking annual recurring revenue growth, demonstrating the success of their strategy shift to recurring revenue model. The stock saw significant appreciation following this announcement. What is important to note here is the shift that they made around 2017-2018 to a recurring revenue software business model. Okay, and this is important because this recurring revenue have 90% gross margin. They are huge margin, so they have 20% margin to install their product, to buy their security product, but the fees that they charge monthly, 90% gross margin, which is huge and which makes this company very, very profitable. Okay, so how do they earn money? First, it's product sale. Okay, they have a wide range of security products, including intrusion, fire alarm system, access control system, and locking devices. These products are sold to distributors, dealers, and integrators who will then install them for the end user. Okay, they have also access control system. Okay, they provide sophisticated access control systems that are used in various commercial and institutional settings. The system often come with ongoing service contract contributing to recurring revenue. The recurring service revenue, like this is a significant and growing part of NAPCO's business. It includes revenue from services such as alarm monitoring, which provide a steady and predictable income stream. The gross margin in these services is notably high, okay, around 90%, making it very, very profitable segment. And you also have the wireless security home automation. They expand into smart home market with wireless security and home automation products. This includes systems that integrate with other smart home devices, offering both product sales and potential service revenue. This is from the investor presentation. You can find it on their website. If you have a building, you take for example a school, they provide security for all the campus, all the building, plus they will charge a fee. So it comes with a lock on the door, with the fire alarm, the control panel, the locks on different class to know who have access to what and so on. So it's pretty full and it can get integrated in the building very fast, and then they will charge monthly fee to call, for example, firefighter for you and so on. Okay, so this is like the Starlink, where they will charge fee, for example, between $12 and $26 per month. And what is good with this is they charge this to business, not to B2C, but mostly B2B business. Okay, so if it costs $5 more per month on the next year to call firefighter if you have a fire or something like this, you will pay for this because you don't want your stock, you don't want everything that you have in your store to burn when something like this happens. So yeah, it's something where they have very powerful pricing power. So who has a client? You have commercial enterprises, so business of all sizes use NAPCO security solution to protect their asset, employee, customers. This includes retail store, office building, and industrial facilities. A big one is educational institutions. They really try to focus on this area, okay? So this is schools and university utilize NAPCO system to ensure the safety of students and staff. This system helps manage access to building and monitor for potential security threats. They have also government and municipality for same way, okay? Protect building and infrastructure, security solution, okay? So it's from local government and also large federal facilities. And also residential, more and more, they are into the smart home technology, fire alarm system, automation product for home, like everything around the IoT and so on. So yeah, it's a pretty good business, and surprisingly, it's a small cap because for now they are not making a lot. It's around 150 million revenue. So yeah, there is some big upward for them. So what is the sales by country? 99% United States, 1% other. It's even a bit more than 99% in United States. So yeah, they sell mostly in the US. 40% of the revenue come from the services, 39% from door locking device, and 20.8% from intrusion and alarm, access alarm. So they have some good diversification here, but we can see that 40% of the revenue come from a high margin service. So this is very good, okay? The market is expected to grow between 8.5 and 9% cumulative annual growth rate for the next 10 years. Here are some short-term prediction from the company, okay, and from different sources, government and so on, Statista. The commercial security is expected to grow 7.7%, school security 11.3%, and residential security 12.4%. So it's a market which is still growing, so they have opportunity to get new market share, to get bigger on this market, and then at the moment they have a client, charge them with a monthly recurring service, which is high margin and which is good. Okay, so for the team, I have only the photo of the CEO. It's Richard Soloway. He's the founder and CEO, long-lasting experience in the industry, founded 2 previous companies. You have also Kevin Butchell as the CEO and CFO, 30 plus years in the company, or Michael Carrieri, 24 plus years in the security industry, which is a CTO. So what is remarkable with this team is every important person in this team have been in the company for a long time, so they know well the company, and have been in the industry as well for a long time, so they know the industry, they know what works and what doesn't work for the business in those industry. The owner, we have Fidelity owning approximately 9%, BlackRock 8.9%, Vanguard 7.7%, and Richard Soloway 3.8% of the company. And there is some problem here, not problem, but things that you need to know. He sold a lot of his share. Since the last 3, 4, 5 years, he had a massive sell of his share. So now, is it because he doesn't believe in the business anymore, or is it because he's kind of old now? So he wants to have some cash, maybe give to his family, maybe finance some new things, help his family or whatever. But it's important to note that he has been selling some shares in the last few years, okay? Now when it comes to numbers, we have a very, very good growth, 2-digit revenue growth over the last 10 years, 17% over the last 5 years, and now the last one was approximately 11%. For the future, it's expected to grow 15% per year. I find it a bit high. It's estimation from analysts on FinChat, but it's what expected. For the earning per share, it grew 83% over the last 12 months, okay? 44% CAGR for the last 5 years and 29% on the last 10 years, and it's expected to grow 18%. Some sources say 18%, some others put 14%. Okay, it will not change anything in the grade, but I put 18% here. For the valuation, we'll mostly use 14%. And for the free cash flow, that has huge expected growth for the next year, 35%. I feel it's a bit exaggerated. I don't think there will be 35% growth, but still, over the last 10 years, 33% per year, 24% per year over the last 5 years, and 100% in the last year. The predictability of the revenue here is 4 out of 5, so it's very good, and it gives a perfect score of growth for this company, 100. When it comes to debt, same, perfect score because you have no debt. You have more cash and equivalent that you have debt. So the net debt is negative. So net debt to EBITDA is negative. Debt to equity close to 0%, and interest coverage, because they have almost no debt, is very high as well. So they will not have bankruptcy problem. They should not go bankrupt in the next years. When it comes to efficiency, here's something really nice to see. We have operating margin already kind of high, higher than 10%, but over the last 5 years and now they keep growing thanks to this new business model, this recurring revenue software. So before it was around 11% average, now it's around 29% operating margin. Same thing with return on invested capital, 13% in average of the last 10 years was already good, but now it grew to 54%. So I'm not convinced it will stay at 54 for very long, but for now it is. I think it will go back to something around 25-30%, which is already very, very high. Generally, as when you're a quality investor, you search for something which have more than 15% return on invested capital. So 25% seems pretty good. And return on asset, same pattern. It's been growing years over years thanks to this new business model, and now it's 26%. So we have 82% score, which is very good and very high. Capital allocation, the little problem here is they are issuing new shares, so not a lot, but it's still some new shares issued every year, so it could be nice that they stop or to start some buybacks. For kind of a tech company, security tech company, they have low capex. So on one hand, it's a good sign that shows that they are very efficient. On the other hand, maybe they have some issues with being innovative, and they can have problem if someone have a better technology than them and if someone outpass them. For now, it's good, but we need to see that maybe this capex will have to grow in the next year. And stock-based compensation is very low. So here, good score as well, 83%. And when it comes to dividends, I start paying one 2 years ago. Now it grew like 400%. I expect it to grow for 15% in the next year. Like it's following the revenue growth. And the payout ratio is around 34% now. So you have place to continue hiring the dividend. Plus, it's a high margin business. So should not really have a problem to continue to deliver a dividend and to make it grow year after year. So the overall quality score here is 88%, which is a very good score. okay? Now let's talk about the business itself and its strength, its weakness, okay? The opportunity and the dangers that you would have on this market. The strength here, it's a market leader in school security. And this is important to note because it's a small cap. So it's already good that they are market leader in something about security. So this is a good point. They have generally a better balance sheet than competitors. So they have very, very good capital allocation, very, very good balance sheet. That's why maybe as well they have those fraud people thinking that there may be a fraud here. They also have a product portfolio to cover the whole building. Okay, so it's not only for the doors, it's not only alarm, it's not only door lock. They globally can put security for your whole building. They have a strong research and development and technology leadership compared to their size and also compared to their spending in this. It's easy to integrate the system. The difference that they have with competitors is with NAPCO, you can integrate the system on any system. Someone has something in the school and so on, they can just add a NAPCO service. They don't have to change everything at once. They can just add one by one. And this is very good for NAPCO because they can get shares easily. While the other one, you need to change the complete system of the building to be able to go with the competitor, with the other one. So this is something pretty good, I think, for the business. Now they have, of course, some weaknesses. First one is old direction. I don't know if it's a weakness or no, but I put it in weaknesses because we may have some change in the direction pretty soon. And this may be problematic if it's not some good ones, okay? They are also smaller than competitor, which imply less research and development spending, lower purchasing power, and economies of scale. Yeah, that's a main problem here. Everything will cost a bit more for them. They also have significant portion of revenues coming from a relatively small numbers of distributors. So if you have a problem with distributor, if someone ditch you or anything like this, it can directly affect your revenue. And also they have a manufacturing concentration in Dominican Republic. So if you have some issue, a political issue, geopolitical issue and so on, or directly a problem in Dominican Republic that people are not able to work or anything, you can have some problem to deliver clients, okay? And also geographic concentration. They sell everything in the United States. So could be nice to maybe extend to some new markets. Here comes the opportunities in this market, okay? The recurring revenue expansion with higher margin. I think it's the biggest opportunity to see growth for shareholders here. The smart home integration, it's a new market that they're getting inside and they're getting pretty well inside it. Also an international expansion can create some good value if they do it correctly. The school security market, which is expected to grow 11% per year here as well, you can get some good value. The wireless technology adoption, okay, it's more and more, and a lot of business and so on have old security system and they need now to transit to new one. This can help, okay, but there is also danger. For example, the competitive pressure. Like, they are not the only one doing this. They have competitors, and when it comes to the product itself, competitors can do great as well. Okay, they have potential technological disruption if they don't invest correctly. Cybersecurity threats that everybody will have on this market, of course, but it's a danger that we need to be aware of. And supply chain vulnerability, especially for them that are fully manufacturing from Dominican Republic. So yes, they have good advantages with this, but it can create some manufacturer problems, okay? And in the last few years, we have important sales from the owner, okay? And this can be as well as a sign of there is a problem inside, or we don't know, okay? As Peter Lynch was saying, there is a tons of reason to sell a stock, but if you're buying a stock, it's because you think the price will go up. Here, we don't really know why he sold. I think it's probably because he's getting old and he wants to get some cash out of the business. Okay, he created this business, so he wants to cash out, but we'll see where it goes. When it comes to the Moat, The Morningstar grade is narrow, so you have 3 Morningstar, 3 grade, none, narrow, or wide. Here it's narrow, so it's better than nothing, but it's not a big moat, and it's understandable because we don't really have a big competitive advantage. We have some competitive advantage, but the competitors can create kind of the same system. Nothing blocks the competitor to do all of this. So yes, they have some little things that make them a bit better than competitors, but we don't have something hugely better than competitors, especially in this business where sometimes it will be easier to just sign again with the competitors and changing. So they don't have a big moat. Narrow moat seems pretty fair because they don't have zero moat, but they don't have a big one. The good thing is they're increasing margin year over year, so this is kind of the sign also of a good business model and a potential moat. High return on invested capital, this shows how good capital allocators they are. The switching cost, okay, when you have a client, it's long and difficult to change the whole security system, so yeah. Pricing power, they can higher the price of recurring software without losing clients, as we said before. Like they can just put it a bit higher every year. So it will create some growth for them, 90% margin, without losing client, because it's something about security, like you don't really mess with security and you're too afraid. It's a bit like insurance. You have it and you know that 99.9% of the time you will never need it, but the time you need it, you're happy that you have it, because if you don't have it, you're literally like in a big mess. So that can be a good pricing power. Also adaptability. It's one of the only companies that can be integrated on other security systems. So you can have the whole building secured with Honeywell and few things with NAPCO, while the opposite is not really possible because the other one need to install the whole system. Okay. Now let's talk about the value, at which price can be interesting to buy the company if you like it. So now the share is about $35. Okay, the 10 years average price earning is 37. The actual price earning is 25. The forward PE 25. The expected revenue growth rate is around 14% per year, and the expected earning per share growth rate is around 18% per year. Okay, so now let's go to my calculation device and see. So share price 25. Let's say that the future PE for the next 5 years will not really move, okay? We want to have a discount rate of 13%. That means that we want to know at which price we can buy the stock to have a performance around 13% per year for the next 5 years, okay? The last earning was around 50 million, okay? There is 36 million share outstanding. We'll put a growth rate of 14% and growth rate here of the share outstanding 0. So we expect that there will be no more share issued, and maybe they will start a buyback. But here, let's just say they will stop issuing new shares. So with this assumption, we can have a 13% cumulative annual growth rate for this company. So the fair value would be $35, $36 what we have. If we take the dividend in consideration, it will be 14.74%. So now let's play a bit with those numbers to see what we can expect, okay? If we are very positive, optimistic, here we'll have a growth rate of what is announced by the analyst, okay, of 18%. Let's not do buybacks, let's not do dividends, let's keep this 15% growth rate. We'll have a 17.5% growth rate for the next 5 years, which is pretty good as well. Okay, here now let's be a bit more conservative with this PE. The historical PE, as you saw, it's mostly around 37. Okay, so let's say, okay, we go to 30. Okay, it's been 37. Let's go to 30. We can have almost a 22% per year return. Now let's put this at 20. Let's say that now the company have achieved some good maturity. So 20. We have 12% return if we have a growth rate of 18%. If we have a growth rate of 14%, which is, I think, pretty good with some good margin of safety for the earnings, it will be 8% return. So seeing all of this, it depends what is the scenario that is the most likely to happen. I think For the next 5 years, I think a P ratio of 25 is something plausible, okay? With a growth rate of 14%, okay, the analysts expect 18%. 14% is for the revenue. Here we expect 14% for the incomes. So I think 14% is pretty good without buybacks, okay? I think they will do some buybacks soon, but let's say they don't do any buybacks, we can have with dividends almost 15, without dividends 13.6. So the margin of safety aren't very, very high, but it's kind of a predictable business now that they have 40% of their revenue coming from 90% gross margin product. Okay, so the grade I give to the valuation here is 75%, which is very good. We don't have extremely high margin of safety, but we still have some, and we're still on a good value compared to what it can grow and the quality of the business that they have now. So to conclude this video, focusing on recurring revenue is great for the business and should be very profitable for the future, especially at the pace they are going. And as well, if we see something like FICO, can be great. It's a great business with growing margins, so this is very good. They have good capital allocation. Here, I think it's important to take hard margin of safety, okay, because I have doubt about the quality of their moat. For me, the main problem of this company is the moat. Is it a company with a very good moat? I don't know. They have a moat, like for sure, but is it a very powerful one? I have doubt about this. I will not be very confident to say that in the next 10 years, this company will be in first position on the market, will still have a good dominance on the market and will be able to grow that much. They have a big growth potential, of course, but I don't know where they will be in 10 years. It's very difficult to imagine like how big this company can be and how safe it can be as well, because the moat is narrow. We have one, but it's not a very big one. So this is on what I will conclude. If you think the margin of safety we took for the valuation are good and the business is good, around $35 can be a good price. If you think the moat is too little, maybe you should pass and try to find some other company. It depends what are your goals with your portfolio, but if you want to beat the market, you need to either take good risk or either only focus your portfolio in companies that have the potential to be very big and that have a good moat, good capital allocation and good growth. If you think they can be this, so then it can be an interesting time to buy around $35. I invite you to tell me in the comment section, what do you think about NAPCO security system? Do you own it? Do you pass on it? Do you think it can be a great opportunity? At what price would you buy it? I will be happy to read you and debate in the comment section. I will see you in the next video. Bye.